Well, it's May 2022, the stock market has plummeted, interest rates have skyrocketed, and I'm sure you're seeing a ton of conflicting information out there about recession, housing market bubbles, and doom and gloom. So let's check in and see what's actually happening with the housing market both nationally and locally here in Spokane. My name is Phil Wells, I'm a real estate agent that likes to keep up to date with the market, and I want you to be as informed as possible too. In this video, we're going to look at national pending home sales, we're going to look at mortgage rates as well as mortgage application rates. And of course, we'll look at the Spokane market itself. We'll then move on to look at some real estate news that stood out to me recently before piecing it all together at the end and seeing what it means for you. So let's get into it. Looking first at national pending home sales. Just a note on all the figures throughout this video, they are the latest figures that are available, but there is often a lag when it comes to reporting these figures, particularly at the national level. For example, the pending home sales that we're going to be looking at detail pending home sales from March. We obviously look at pending home sales rather than closed sales because it actually takes a while to close a transaction. So closed sales in March would represent activity back in January and February time, whereas pending home sales give us the most up-to-date impression of what the market's doing. Contract signings declined 1.2% month over month in March 2022. Year-over-year contract signings declined 8.2%, which represents 10 consecutive months of year-over-year sales declines. So we continue to see compression in an already heavily squeezed market there. I continue to believe this decline in sales is because you can't sell what you don't have, and inventory is tighter than it's ever been. Where I am in the western region, sales declined at 0.2% in March, and they declined 8.4% from the prior year. Here's what the National Association of Realtors chief economist had to say. The falling contract signings are implying that multiple offers will soon dissipate and be replaced by much calmer and normalized market conditions. As it stands, the sudden large gains in mortgage rates have reduced the pool of eligible home buyers, and that has consequently lowered buying activity. The aspiration to purchase home remains, but the financial capacity has become a major limiting factor. Overall, existing home sales this year look to be down 9% from the heated pace of last year. And here's an important bit: home prices are in no danger of decline on a nationwide basis, but the price gains will steadily decelerate, such that the median home price in 2022 will likely be up 8% from last year. While costs have soared for existing new homes, rental properties have seen monthly jumps too. Fast rising rents will encourage renters to consider buying a home, though higher mortgage rates will present challenges. Strong rent growth, nevertheless, will lead to a boom in multifamily housing stock with more than 20% growth this year. So some signs there that the increasing interest rates are beginning to cause resistance in the rapid price growth we've been seeing. But also an indication there that prices and the equity that homeowners have built up recently aren't going to start unwinding rapidly anytime soon. I think the low inventory that we've been seeing may actually serve a useful purpose in the coming months and years and prevent the housing market from going into a correction. The reason for this is that the freakishly low inventory we've been seeing recently keeps buyer demand high, which keeps prices high. And it doesn't look like that's going to change for the foreseeable future, albeit we will see slower appreciation than we saw in 2020 and 2021. This economist does imply that buyer demand is down a little bit, but it's worth remembering that it's down from a fever pitch to a gentle boil. It's still strong. It's worth mentioning also that figures from Realtor.com suggest that inventory is beginning to climb as you'd expect in a normal market with seasonal trends. But please remember, this doesn't mean that the script has completely flipped and there's now more homes for sale than buyers to buy them. No, the number of buyers out there still far outstrips the number of homes for sale. All that's happened is that the gap has slightly narrowed. If you are considering selling in this market, please still remember there are still some very well qualified, very serious buyers out there. The ones that were likely to win a bidding war in the first place. A lot of buyers are being squeezed out of certain price points and are forced to look at lower price points, and people at the lower end of the spectrum are being forced out of the housing market entirely. But there is still a pool of very well qualified buyers out there. And remember, if you do decide you want to list your Spokane home, please consider me as your listing agent. I can be very competitive in terms of commission rates, which keeps more of your equity in your pocket. Let's move on to look at mortgage rates. Obviously, most buyers are using a mortgage to buy a home, so to keep an eye on mortgage rates gives us a really good idea of what buyer demand is looking like and what buyer demand is likely to do. Rates are also attracting a ton of attention, so it's important to actually hone in and see what's really happening with mortgage rates. Sticking with March for a second, mortgage rates at the start of March were at 3.9%, and by the end of March they'd risen to 4.78%. The most recent rates I could see have risen sharply to 5.52%, which is the highest I've seen them since I've been working in real estate. But it is worth noting that in the past month, they've only risen 0.5%, which is a slowdown in the rapid increases we've been seeing of late. I sincerely hope that 5.5% is the highest they'll go before they start to come back down, but no one expected this recent jump in rates, so I'm not holding out too much hope on that one. The Federal Reserve has raised rates 0.5% since we last checked in, and they've raised rates 0.75% this year, but that simply doesn't explain the 3% rise in rates we've seen the past few months. Is the US economy starting to crack? Is near 10% inflation on top of a war in Europe, on top of printing money, on top of labor and supply shortages beginning to take its toll? At the fundamental level, rates go up to account for extra risk in the economy, and it seems like the US economy is not as safe a bet as it was this time last year. All I know for sure is that increasing interest rates only serves to push aside those lower income buyers and those first time buyers that are only just qualified to buy homes. I have personally seen this with some of my own clients that are looking to buy homes, who are content to just rent until they see the conclusion of things like the war in Ukraine and even the midterm elections. So rates are up, that's undeniable. It's important at this point to remember that buying real estate is always a good idea, and you're not necessarily stuck with the interest rate that you close on the home with. Eventually rates should come back down and you can refinance at that point, taking years off your mortgage and putting yourself in a really good financial position. Also, if you're willing to compete in this market, you may actually find yourself encountering less competition than you would if you were competing this time last year. It's also worth recalling what the economist in the previous section said about home prices, namely that they're not likely to go anywhere, they're actually likely to increase by 9% this year, and then to continue to increase for the foreseeable future. So if you're concerned that home prices are going to tank the second you close, just remember that there's no real signs that this is going to happen based off the information that we have at hand right now. And I am practicing what I preach. I'm not just saying it because it sounds good and every real estate agent says it's always a good idea to buy a home right now. Since we last spoke, I've been fortunate enough to buy a home, but I have got a mortgage with a far higher interest rate than I'd like. I did this because I know eventually rates will come back down, and buying a home is still a great wealth building tool, so it will make sense in the long term. I also wanted to take advantage of some reduced competition. I was able to get my second offer under contract using this method. It's not the perfect home, it's not my forever home, but it will certainly do for now. Sticking with mortgages and looking at mortgage application rates. After all, it doesn't matter if mortgages are at 2% or 7% if nobody's actually applying for a loan after all. So let's head over to the Mortgage Bankers Association, the MBA, and see what the experts are reporting on this issue. We are no longer looking at March now. This organization publishes figures weekly, so we're able to get a really good up-to-date impression of what the market's doing. The headline looks good, but let's dig deeper into the story. The 127 basis point jump in rates over the past 2 months has triggered a 49% drop in refinance activity. This should be obvious and shouldn't come as a surprise. Who in their right mind is going to refinance at a 5.5% rate? This is good for purchasers though, potentially, as appraisers aren't tied up with refinances like they were at the start of the pandemic, meaning you can likely close on a home sooner than you otherwise would. In terms of purchase applications, which I really care about, purchase applications increased for conventional FHA and VA loans, and were up 4% overall. This is potentially a good sign for the spring home buying season, which has seen a slow start thus far. The purchase market remains challenged by low levels of housing inventory and rapid home price gains, as well as the affordability hit from higher mortgage rates that are forcing prospective home buyers to factor in higher monthly payments. So despite mortgage rate increases, we're still seeing purchase applications up, which is a really good positive sign for continued strong buyer demand. Ultimately, people need housing, and it's something they're prepared to pay for in most circumstances. People may have to downgrade their expectations in order to find a home within their new budget because of increased interest rates, but people are still buying homes, that's plain to see. So to sum up, I remain confident that increasing interest rates will not dampen the market too much and won't cause a downturn in prices, but will instead cause appreciation to decelerate to closer to historic levels. Housing is such an important factor in people's lives that if people need to downgrade their search criteria by 50 to 100k in order to find something they can afford, then chances are they probably will. If you're a buyer right now in this market, know that it's still very competitive out there. There are still some very strong, well-qualified buyers in the market. However, competition is waning slightly, which might make it easier on you than it has been for the last couple of years. You will still have to be aggressive, and you may end up with less home than you initially envisaged, but you can still get on the housing ladder, you can still move up the housing ladder, and buying a home is still, and always will be, a great wealth building tool. Now let's look at my local market, Spokane. Actual sales were down 6.9% in April. As I always say though, a decline in sales means one of two things. One, there are fewer homes to buy, and two, nobody wants to buy a home. As we can see later on in this report, while inventory is up, it's up from a 10-day supply this time last year to a still woefully low 19-day supply this year. For reference, a balanced market would have a 3 to 6 month supply of homes. It is nice to see new listings up slightly. That's a positive note for the busy summer selling season, and it tracks what's happening nationally in terms of inventory. Median home prices continued to move upwards rapidly here in Spokane, with median home prices holding above the 400k mark, which is uncharted territory here in Spokane at 425,000. So it's plain to see that demand is still strong here, otherwise these double-digit year-over-year appreciation figures would start dropping off and inventory would start to increase. Those most desirable homes are still flying off the market, while those homes that would realistically struggle to sell in any other market are taking a little longer to sell, but are still selling. If you're a homeowner right now and you've owned for, let's say, a year, you probably have a strong equity position given how much prices have increased here in Spokane in that time. You're in a market with above average demand and below average inventory, and there's a great window of opportunity to list your home for sale before buyer demand could potentially change. And as I mentioned previously, I would love to help you list your home for sale if you do decide to sell. If you're a buyer right now, it's tough, but there is a silver lining to the higher interest rates we're seeing. Chances are you will begin to see reduced competition in the coming months as casual buyers are pushed out of the market by higher interest rates. But please don't mistake what I'm saying for an easy ride. It's really not. It's a very competitive market out there still, but you may find yourself having to make fewer offers than your counterparts would have had to make this time last year. Now I wanted to look at a few news articles that stood out to me this month. If you're new to this channel, I like to cover news articles because frankly, numbers don't always tell the whole story. So I add in these articles to contribute extra context, to dig deeper into issues, and to provide a perspective that I might not have covered. So let's dive straight in and look at the main topic in housing right now. Are we in a housing bubble? This article comes to us from Realtor.com. It's actually one that I would really encourage you to read in its entirety, and I will link the article in the description to this video. It pits multiple experts on different sides of the debate against each other, and it really doesn't arrive at a conclusion. And I think that should tell you everything you need to know. No one knows what's going to happen in the market, and you should be cautious about listening to anyone who claims to have it all figured out. Here are a few highlights from the article. We're not in a housing bubble just yet, but we're skating close to one if prices continue rising at the current pace. Some markets will see a correction if mortgage rates continue to rise, in which sales will drop and prices will follow, but I don't expect the market to see a huge crash or a spike in foreclosures. You're now starting to see people stretch their budgets. The market looks more frothy than it did 6 months ago. People go from "I need to lock in rates before it goes higher" to "honey, we can't afford this anymore." Then it needs to sink in for home sellers that they might not be able to get as much as they wanted for their residences. Sellers are pricing homes based on the market 3 months ago, not the market of today's interest rates. We're in a period of transition where sellers are looking at the lack of homes on the market and current record high prices and assuming the market will continue like this. I'm expecting to see price adjustments as we move into the spring and the summer. Sales will drop before prices adjust. The housing market is becoming bubbly. This looks a lot like the housing boom we saw prior to the 2007/2009 financial crisis. Others like Carlyle and Wolfe aren't as sure. However, all three believe there could be a correction in the housing market which would lead to falling but not crashing prices. It's like air escaping from an overpressurized tire through a very small puncture. The tire is not going flat quickly, but it will slowly soften. And this one's worth remembering for everyone. A universal drop in home prices across the entire country is rare. we need to be realistic that home prices could eventually come down a bit. A very interesting article with too much in it to cover in this video. I'd really encourage you to check it out. Now I wanted to look at what the Federal Reserve is doing and their plans to hedge inflation. Official inflation is at 8.3% for April, although many argue real inflation is much higher than that. And the US economy just shrank 1.2%, leaving us 1 quarter away from an official recession. So the Fed needs to do something and needs to be seen to be doing something. Expectations are growing that the US central bank will hike interest rates a whopping 3 percentage points this year. By sheer number of hikes, this would be the most active Fed since 2005. But by size and magnitude of each hike, it would be even more notable. The Fed hasn't adjusted interest rates that much since the 1980s, the last time inflation became a major problem for the financial system. I really hope inflation peaks soon and starts to get under control, because while I'm confident the housing market can stomach 5% rates, I'm not so sure it could stomach 7% rate. Strong buyer demand and low inventory is really what's keeping this market going. And while a gradual transition towards a more balanced market is welcome, I'm concerned that if supply increases and buyer demand is artificially stifled, this could be pretty bad for the housing market. Let me know your thoughts in the comments about whether increasing interest rates is the right way to ward off inflation and a recession. Lastly, I wanted to re-emphasize the point that I don't see home prices falling in the foreseeable future. Experts say the housing market isn't set for a price decline due to the ongoing imbalance between supply and demand. In the latest home price forecasts for 2022, they're calling for ongoing appreciation throughout the year. You can see here that various different outlets are predicting various different price growth rates, with the average being 9%. While home price growth is expected to moderate from the rapid price growth in 2021, strong home buyer demand against a backdrop of historic tight inventory of homes for sale will likely keep appreciation positive in the coming year. And we can see in this graph, projections into the future out to 2026 show home price appreciation decelerating, yes, but coming down to around the 3.5% mark, not turning negative, which is good for everybody with an equity position. This is the point I've been trying to make now for about a year. Markets at their core are just supply and demand, and the housing market is no different. With buyer demand still strong and the supply of homes still very, very low, it seems improbable that prices would change dramatically in the foreseeable future. Unless a huge supply of homes comes on the market and buyer demand is cut in half, the market will continue, albeit at slower appreciation rates, for the foreseeable future, in my opinion. Now let's try piece all this information together and summarize the market as we see it in May 2022. The big news is that interest rates have risen dramatically, beating all expectations. This hasn't destroyed buyer demand though, but admittedly it has pushed aside those more casual or marginal buyers. We continue to see compression in the housing market, with sales down nationally on a year-over-year and month-over-month basis. Despite all this though, low inventory continues to cause price appreciation to grow. Although we are starting to see evidence of more inventory coming online for the spring and summer selling season. Will this cause a return to normalcy, or are we about to see a buyer's market on the horizon? I personally believe that buyer demand is coming down from such a high level and inventory is coming up from such a low level that they're unlikely to intersect for the next few years, and the market will likely continue to be a seller's market for the foreseeable future. However, I do expect to see home prices begin to decelerate to closer to historical norms of around 2 to 3% for the next few years. Sales are down here in Spokane. We continue to see woefully low inventory, though there are some signs that a little bit more inventory is coming online for the spring and summer selling season, as it is nationally, which is a good positive sign for the frustrated buyers out there. And buyer demand remains strong here in Spokane, which is a positive sign for those looking to sell this season. It's still a seller's market out there, but buyers are going to begin to be able to point to things like interest rates to say things like, look, we can't simply keep bidding up homes, it's just not affordable. It's a very interesting time in the market. I'm going to be watching it closely as always. That's it for this video. I really hope you gained from this video. If you did, please like and subscribe. That really does help me out. If you are looking at listing your home for sale in Spokane, then please consider me as your listing agent. Like I said, I can be very competitive in terms of commission rates, which keeps more of your equity in your pocket. If you're looking at buying a home here in Spokane, I would love to hear from you and I'd love to help you get your dream home. Like I said, my name is Phil Wells, and thank you for watching.